millions of middle-class earners find themselves living paycheck to paycheck, and they naturally blame themselves for a lack of willpower. But individual discipline isn't the primary issue. They are operating in an environment specifically designed to extract their wealth. Welcome to the default American ecosystem. The most normalized wealth-destroying trap in this system sits right out in the open: the modern car dealership. Years ago, the auto industry made a calculated switch. They stopped competing on the total purchase price of a vehicle and started selling based on the monthly payment. This allowed them to stretch loan terms out to 72 or even 84 months, completely obscuring the true long-term cost of ownership. This flowchart shows exactly how the perpetual debt machine works. A buyer wants a $45,000 car, but they owe $6,000 more on their current trade-in than it's worth. The dealership simply rolls that $6,000 in negative equity into the new loan. The buyer walks out with a $51,000 loan on an asset that loses value the second they drive it off the lot. This tactic extends far beyond car loans. Credit card companies rely heavily on behavioral nudges, designing minimum payment structures and rewards programs to subtly prioritize your present consumption over your future security. Active mutual fund managers use similar psychological levers, taking high explicit fees while failing to beat the market. The standard American financial life is mathematically engineered to extract money continuously. If you live like everyone else, adopting the normalized behaviors of your peers, financial fragility is the guaranteed outcome. To see what happens when the defaults are reversed, we have to look to Australia. They have built structural systems that automate wealth accumulation instead of perpetual debt. Every Australian worker participates in a mandatory system called superannuation. Employers contribute 11% of an employee's earnings directly into a retirement fund. The behavioral principle is simple: pay yourself first, automatically, before the money ever touches your checking account or triggers the desire to spend it. Their banking system reinforces this habit. Major Australian banks offer bonus savings accounts that act as a behavioral commitment device. They pay higher interest rates if you make a monthly deposit and penalize you with a rock-bottom base rate if you make a withdrawal. This diagram shows the psychological power of engineered friction. By keeping everyday checking and dedicated savings accounts at completely separate banking institutions, you create a mandatory 1 to 2 day transfer delay. That tiny amount of friction is highly effective at interrupting impulse purchases. High savers are rarely more disciplined than their peers. They simply reside in an architecture where saving is the path of least resistance, while spending requires conscious, deliberate effort. The American FIRE movement, financial independence, retire early, is built on a calculation that separates retirement from income level. Your timeline to freedom is dictated entirely by your savings rate. This graph plots the exponential curve of that math. At a standard 15% savings rate, you face a 40-year working career. But if you increase your savings rate to 50%, the curve steepens sharply and drops the timeline to just 17 years. Keeping this visualization, let's look at the opportunity cost of that standard car payment. If you passively invest $600 a month instead of handing it to a lender, over a 30-year career, that cash flow compounds into nearly $1 million. To capture those compounding returns, you have to invest passively in broad index funds, baskets of stocks that track the entire market with near zero fees. The stock market is a highly competitive information processing environment. The SPIVA data, which tracks active fund managers against market benchmarks, proves that 80 to 90% of Wall Street professionals fail to beat the market over the long term. Securing that capital to invest requires adopting a defensive cultural mindset. In Australia, the tall poppy syndrome acts as a social brake on flashy displays of wealth, cutting down those who show off. Applying a similar mental filter protects you from the American urge for status signaling and conspicuous consumption. Reaching an extreme savings rate demands aggressive mathematical discipline, but equally important, it requires a robust cultural defense against a society built on status-driven spending. This visualization captures how the financial media operates. They profit by injecting emotional urgency into your daily life. They promote market timing, the attempt to predict when the market will rise or fall, because it keeps you watching. Historically, this reactive buying and selling destroys individual investor returns. You can opt out of this entirely by executing an actionable blueprint. Automate a 20 to 50% transfer of your take-home pay to a separate bank on the day your paycheck arrives. Buy reliable, used cars and cash. Direct savings into low-cost index funds, and ignore the financial news cycle. To sustain this, you need to adopt a saver's identity. You have to internalize that saving is an expression of who you are, rather than a grueling daily battle of willpower over what you are trying to do. Financial independence is the pursuit of personal agency. By changing your defaults today, you stop funding the profits of extraction and begin securing the time and autonomy of your future self.